How you doing? Pleased to be here. So everyone who gets up and talks about the stock market, they have wondrous views and wondrous strategies and ways you should make money and all the rest of it. Well, I think today I'm going to do slightly the opposite. I'm going to tell you how to lose money. You say, well, why do I want to lose money? Well, knowing how to lose money is kind of the basis of how you approach each investment today. You should approach each investment with not how much you can make, but how much you could lose. So you approach it in a degree of risk. So if you know how to lose, then ultimately you limit your downside and you raise your upside. So my whole life, 30, 35 years, has been about creating value. Whether it's been an investor, whether it's been a trader, a portfolio manager, looking for company value in breaking up companies, is about creating value. So that's all I do. That's all I know how to do. But I suppose ultimately, I'm going to tell you the opposite. And I'm going to say, you know, there's going to be ways of how people lose money. And hopefully you learn from those. Okay, so we're on the nautical theme today. And you know what? The stock market, you may not know so much about it, but it's a blend of calm and chaos. And there's three main areas in the stock market. There's one where there's big tidal waves that come along, and those tidal waves could be change of governments, they could be political unrest, they could be wars, and they move markets pretty significantly, and you've seen that. The second one is more of a micro level, and these are with companies, individual companies who report earnings, who report differences in what they predicted and where they're going to and where they're coming from. And lastly, unpredictable events. We've seen the pandemic. The pandemic hit us out of the blue, and it moved markets, and also high frequency trading too. But what you've got to remember is this: the duality of the market volatility is both a risk and an opportunity. So, where are we? And there's essentially three ways which most people lose money. And the first is, I'll make out a little bit here. And the first is the illusion of following trends. Now, it's interesting because people say to me, Jim, what books do you like? Well, I like books that are insightful. I like books that help me. I like books that challenge me a little bit in what I do. And one of those books was written in, would you believe, 1841 by a guy named Charles Mackay. Now, Charles Mackay wrote Extraordinary Popular Illusions and the Madness of Crowds. And it just highlights reoccurring financial follies that people chase. You had pyramid schemes like the Mississippi bubble, the South Sea bubble, the Mississippi scheme, but also one you'd be familiar with is the tulip mania, where tulips were worth more than gold. Just think of that for a second. People were trading tulips and they're worth more than gold. So it kind of brings me to these three areas. But what I want to try and say is history repeats itself in terms of chasing these follies. And you say to me, well, Jim, you know what? 2024, we're a little bit smarter now. Fantastic, great piece of history. We're not going to fall for that stuff. But you do. There's an interesting story. It's a fable, actually. And I don't know whether it's over here. You understand my British accent, of course. But it's called The Emperor's New Clothes. Now, it's a fable. I don't know if it's true or not. I like it to be true. But essentially, what happened was there was an emperor back in the day, and he was going out on his big parade at the beginning of the year, and these two swindlers saw an opportunity. And they said to him, you know what? We have the most magical clothes for you. You're going to look the best. All the other emperors, all the other kings, they're going to admire you. You're going to be fantastic. But there's one caveat. If you can't see these clothes, you are stupid. So he says, okay, well, I'm not stupid. I can see this stuff. So they set by their imaginary sewing and clothes, and they're putting them up, and they're dressing them. They say, how does that fit you? I said, that's great, fantastic, lovely, because he didn't want to look stupid. So he sets out in his parade. They dress him up his clothes, they take his money, they go, never to be seen again. Goes on his parade, and essentially all the crowd and all the kings were told, well, if you can't see these clothes, these magnificent clothes the emperor's wearing, you are stupid. And he comes and they cheer, they go, fantastic, great. And he's up on his chariot, and he's naked, of course. And he's saying, well, you know, look at me. And one little boy stands up at the back and he says, the emperor's got no clothes on. And everyone's like, well, yeah, that's right. He's got no clothes on. And it all ends in tears. So my point being in that is the crowd group thing today is very, very relevant. And I'm going to show that with a couple of examples. But that just underlines what I'm about to talk about. So let's bring it forward in terms of that sort of thing and exactly what Charles Mackay talks about in his book of charismatic leaders. Now, one charismatic leader back in 2022 was a fellow named Sam Bankman-Fried. Sam Bankman-Fried started the cryptocurrency exchange FTX. Now, I saw this investment come across my desk. I just didn't know what it was about, so I didn't invest. And what he managed to do was entice people with huge returns on cryptocurrency more than they could make elsewhere. So it was alluring. So essentially what he did was gather a lot of funds, and he actually gained $28 billion worth of dollars. $28 billion. And essentially, what that collapsed a year later, but what actually happened was he was found to be funding his own lifestyle, funding his other businesses with the money. So how did he raise that much money? And important people like Mr. Wonderful. Mr. Wonderful was here a few months ago, invested money and lost money. So all these people investing money into something they didn't know about, and there was no returns. Interesting. Second one is in terms of groupthink, is what we were talking about. Now, Wirecard was a DAX 30 company. If you don't know what a DAX 30 is, it's a leading companies in the German market. And Wirecard promised in 2020 that they would make 500% profit for you. You invest in their stock, 500%. They were a card process system. So what do? So everyone's rushing to invest. Turns out, a year later, the 1.9 billion euros they said they had in the Philippines just wasn't there. But everyone invested. And lastly, Luckin Coffee is a great example. Luckin Coffee, now here's the premise of this one. It opened on the NASDAQ 2019. Everybody's buying a stock. Everybody's buying a stock. What was their premise? Premise was they would change the culture of China from tea drinkers, from resolute happy tea drinkers to coffee drinkers. Kind of dumb, eh? Wasn't for a lot of investors. They invest millions of dollars in there. Turns out they fabricated 319 million of sales, stock collapsed. They made it all up. So you're telling me we've moved on. We haven't moved on. These are recent examples, and I can give you a lot more of people investing because of these particular examples of groupthink, charismatic leaders, and people leading the way through folly. The last one you're going to love, herd mentality. There's a company, 2014 it set up. It comes to light about 2017. He's a new Elon Musk, Trevor Milton. Trevor Milton set up a truck company to say, we've got a new technology. It's hydrogen cars. And everyone's going like, that sounds great, hydrogen in the future to power cars. The next Elon Musk, fantastic, let's all invest. They all invested, stock went through the roof. Then they had a big demonstration. The demonstration was this. The truck was going to drive itself down the hill. Okay? This is a true story. You can look all this up. It sounds fantastic, but this is what it is. So the truck stuck at the top of the hill, and it drove down. It was like, wow, hydrogen, fantastic, the future, I want to invest. Turns out it wasn't hydrogen. It was the force of gravity that brought it down. Everyone was fooled. Stock went to zero. He went to jail. So you're telling me we're not smart. We're never going to be smart. We're always fooled. So that's just one example, and there's two more I want to go through. That's the first example of following trends. The next one is emotional investing. This is one. If you want to lose money, please go this route. Because emotions will drive your particular preferences. Now, let me just put that one in the middle. To 2002 meme stock craze. Maybe you don't know what that is. Now, the pandemic was interesting for the stock market because it opened up a whole new investors because they couldn't bet on sports. So where do they all come? They come to the stock market. They didn't know what investing was. They just wanted to bet. It's fair enough. But they bet on lots of strange stuff. Stuff like Kodak, stuff like BlackBerry, stuff like cinemas, which were all businesses were completely dying. And these things went up. And people thought it was great. And they joined them. They went to zero. Another one was, which sticks out for me, is Peloton. Peloton Obviously, you know, it's a fitness company. It just produced a bike back then. But at its height, Peloton's valuation indicated that everyone in the US would have a Peloton bike. Here we are. There was a guy who used to argue with me and say, you know what, Jim, you're an idiot. This is going for the moon. It's now at $4 to reach a high of 180. It's struggling for its life. So these are kind of things you need to recognize in terms of emotional investing. And you need to use two things. You need to use an analytical edge, which we're going to come through, but also a behavioral edge when you're approaching the market. And the behavioral edge is in two sections. The first section is recognizing your biases. Are you just out of an anchoring bias? Are you just looking for stuff to back you up? Did your mate tell you and you're like, yeah, this is great, fantastic, let's all get in. Hydrogen, hold on, what's hydrogen? Did you know it's one of the most dangerous subjects? It's never going to be on cars, it's going to blow up. But you invest in it. So that's where you've got to realize what those biases are, what your biases are. And then you've got to realize what the market bias is. Peloton saying that every company at that value, every person in the US would have a Peloton bike is just ludicrous. And there's plenty of examples of that too. So that's what you've got to look at in emotional investing. So I want to keep going there. And the last one is critical role of research. Now, Peter Lynch, great investor, he said, most people spend more time choosing their washing machine and fridge instead of looking into the stocks they buy. I guess some people are nodding their heads. But you'll be looking at the price comparison charts. You'll be looking and be like, you know, hey, honey, this one's got a ice machine and a crush ice and this and that. And this is great. Do you want to invest in hydrogen? Yeah, let's do it. So you've got to recognize that critical role investing, invest in what you understand and start with the risk. And start looking at the company reports and start looking at what they produce and start looking at the management and how quality they are and how credible they are, because you'll lose otherwise. So and look for an analytical edge. So it comes back to the edge again. So you've got the behavioral edge, which we know about, and it's managing your biases and the market's biases, but also the analytical edge in what do you see that the market don't? And if you don't see anything, and you're just joining the crowd, and you're following the trend, and you're using your emotion, you will lose. So recognizing these three things in investing will manage your downside risk. That's the point. What I'm not selling is I'm not selling upside. I'm saying manage your downside. Because would you believe most people can pick stocks? It's just a matter of timing. So here we have three areas which I want you to take away today, because I'm kind of running over time, but I want to make sure that you understand the three areas which you can really lose. And just to conclude, you have to approach the market with, I had a question from a student the other week, and she said, Jim, she said, you know what, just give us the idea on how to make some money and how to buy a car and get our holidays, and I'm good. I'm like, no, you're not going to do it. You're going to lose. So the point being is, you have these three areas of do not follow trends, do your research, and make sure you manage your emotion. Because if you do those three things, you'll manage your downside. And it's all about approaching risk. And this is what this college is all about, approaching risk first and then upside later. So in the dance with markets is what I call it, and your compass, clarity and wisdom are your most valuable assets. Thank you.